Ravi Dharamshi joins us now. Good morning.
Hey, morning.
I thought you would be glued to your trading screen. You are in the studio looking relaxed on a day like this.
So probably for a trader it matters more. From an investor's perspective, I guess policy continuity and political stability is in the bag, and I don't think a few seats here and there is going to matter.
What is in the price, what is not in the price? They always say the investor looks at what is in the price, what is not in the price. So for an investor like you, what is in the price, what is not in the price?
No, so see, markets have been rallying for the last 4 years since the bottom in March 2020. So one cannot ignore the fact that valuations are on the higher ground. Having said that, probably there is a pocket, there are pockets like infrastructure, defense, railways, which have done very well on the back of anticipation of this government coming back as well. So those pockets are definitely on the more expensive side, but there are other pockets like private banks, consumption areas, which are not so expensive as well. So I won't pass a judgment on the entire market that markets are expensive. In fact, the large caps are not so expensive as well.
Okay, let's look at a very simple thought here, and again we were discussing this with everyone in the morning. If you look at Modi 1.0, the focus was largely towards getting Digital India right, getting the house in order, fixing a lot of loose ends like power and roads. 2020 was put towards Atmanirbhar, which is, I'm just breaking this question for the benefit of our viewers. If you bought defense stocks in Modi 1, you did not hit a home run. But if you bought the same set of stocks, let's say post 2020, you hit a home run. Do you think the set of stocks which will outperform and which could potentially outperform in Modi 3.0, could that be different?
No, so as you rightly pointed out, the performance of the stock depends on the entry point and the valuation. So I do believe that the priority might change for the government in the coming 5 years. The first government's agenda was to put the house in order. The second government's job was to kind of kickstart the investment cycle. This particular government's job will be to actually put money in the hands of people, is what I strongly believe. I think with the kind of tax rate, tax collections and GST collections we are seeing, I think there is a strong case to be made for the rates to come down. And if that's the case, then I think that should finally kickstart the consumption cycle, especially at the bottom of the pyramid, which has been languishing since a while.
So how would you be investing differently in next 5 years versus how you've invested differently in the last 5 years?
If you honestly, if you want to make money from a 5 years perspective, go where nobody is looking, and consumption, and which includes discretionary as well as non-discretionary consumption, and sorry, I'm forgetting, but essentially
rural consumption
and exports are two areas which I think should should start doing well. What has been doing well, infrastructure and all, I think market has kind of factored that in, and valuations are on the other side now.
So next 5 years, Asian Paints will make more money or SBI will make more money?
Without naming any particular stock, but I think stocks that have not done well.
You can talk about it.
Stocks that have not performed well for 5 years is the place where one should be looking at.
You know, Ravi, I recall that when you had come to our studios about a year ago, I think it was, that you spoke about that manufacturing renaissance, and that really has already played out. What's the sense that you're getting at a time like this? Is this a prudent portfolio allocation strategy to still look at that entire manufacturing space?
Absolutely. Manufacturing is going to continue. It's not a trend that's going to reverse. But in a longer term trends, there can be periods of no performance, underperformance. And I think this theme has been well recognized in the market for this point of time. I think most of the companies are factoring in 2 years forward numbers. So one should be careful in terms of entry point. But from the perspective of companies doing well over a 5-year, 10-year horizon, I have no doubt about it.
Ravi, you're talking about how the underperforming sectors are likely to reverse, and one such sector has been pharma for the last few years. Is that something which could be a bit of a dark horse as well, and which segment within that?
I think you are right. Pharma can be a segment that does well, but pharma does not seem like a top-down sector that is going to do well. It's more a selective bottom-up stories that are likely to do well. The revival in the first part is the US generics, where the price erosion is kind of ebbing for the moment. So that is a segment that is doing well. But what we are very keen on is some niche, some specialty where the competitive intensity is on the lower side. So there are certain pockets where the profit pools are still pocketed, protected, and those companies I think can do well over a longer term period.
Now what do we have? We have a drop. We do have a drop, a gap down start, and the gap down start is just not getting filled. Look, technical factors are at play here. Before you judge today's market independently, let's look at what happened yesterday, and then we are still higher from Friday's low. I simply put it this way. I can pour cold water by saying that large part of the gains yesterday have gone away, but you have to always put things into context. Don't look at the market for next 2 or 3 days, look at the market for next 2 or 3 years. That's what we've been maintaining, that this is a market where you may see a knee-jerk reaction, you may see a compulsive here and there, but that's not the way of looking at the market. Ravi, one debate which everyone's having is that the positioning of FIs has been short, and that's one big factor which could be a moving factor. FI short means that they may come back. FI short also means that they are bearish. If markets like what the verdict is, which is what it appears right now, looking at the leads, 295 NDA, 201 NDA, looks like BJP Sarkar aa rahi hai dobara. Could FIs be forced to exit their short positions?
I think that is likelihood, and I wouldn't be so worried on the large cap valuations. Honestly, large cap valuations are not that expensive. So positioning not only in the derivatives market but also in the cash market, I think it's at a 11-year low. Foreigners equity positioning is I think at around 16-17%, which is on an 11-year low. So from both the perspective, I think with the event out of the way, uncertainty being gone, presuming what the early leads are showing, the trend stays, even with that the government is coming back, I think money will get allocated. Only hitch over here is the valuation. And India is still part of that emerging market basket, which is actually not seeing inflows. The money has all been flowing towards US market. So those are more the reasons why money has not been coming to India, but that should change going forward if the political stability continues.
Do you think that at a time like this, it's the large caps that present a good tactical positioning versus the mid and the small caps?
In general, you are right. Having said that, the definitions of small and mid caps have changed. Even a $10 billion market cap company is now a mid cap company. So these are all largish companies. But honestly, yeah, from a larger, if we had to slice it by market capitalization, probably because FII money has not come in, and that money tends to come into the large cap space, that is the space that should do well if the FII money comes back. The domestic, I think Juggernaut will continue to roll on. We are sitting on, all the mutual funds are sitting on enough cash, and that money should also get deployed. So barring today's reaction, I am not really worried about the market's trend changing at this point of time.
But yeah, for now the market is reacting quite negatively. You do have the Nifty below the market 22,800. Reliance is down a solid 4% as we speak, so 3.5% down there. HDFC Bank has seen quite a bit of dropping. L&T is down almost 5%. SBI, the big star performer of yesterday, which was up 9%, has taken a bit of a knock, 6% lower. Ravi, just wanted to get a sense from you, the private banking names, the HDFC Bank, IndusInd, Axis of the world, what would make them turn the kind of underperformance? Is it just going to be the FII money coming back? Is that the biggest monitorable? Or what will make them turn around?
No, so clearly the NIMs are the most important monitorable from the fundamental perspective. From the flows perspective, it could be the FII monies coming back in, but the pressure on the deposit rates is what is causing the NIMs to compress. But I think with the additional dividend from RBI, with the way GST collections are going, I think there is a lot of elbow room for the government to reduce fiscal deficit. That should bring the rates down. And once that starts to happen, I think the NIMs should start, probably going up again as well.
So Ravi, will you wait to deploy fresh capital in the market? Would you wait then for the budget to be done with and then take a call?
No, I don't think budget is likely to be a big event. I think there are a lot of fears about capital gains tax, the period being increased. Yeah. So from that perspective, I think the agenda of the government is pretty well known. With a 3 years perspective, I don't think there is going to be any major change in the budget. So our investment strategy has been to stay invested. It was not dependent on this event. It will not be dependent on the budget as well. And from both the perspective, I feel the markets will continue to track the global macros and the Indian micros, both of them which are looking quite benign at this point of time. So I don't see a reason why there should be a major move post any of these events.
Okay.
You talked about urban consumption because he was talking about, he talked about consumption particularly taking a bit of a reversal. There I wanted to get a sense, are you looking at the urban theme, the affluent theme which has been doing well for the past 12-18 months, or is it more towards rural now, FMCG, staples and even durables for that matter? Because if you look at those AC inventory situation right now, in May perhaps we hear that Voltas has already seen double their sales.
No, so my hope or my wish is more that the government focuses a little bit more on reviving consumption. At this point of time, it is only the upper end of the pyramid that is doing well. So, and it is more urban consumption that has been doing well, but it's the rural consumption that has been suffering. So, I would really want the government to start focusing on this piece that is not doing well, but that remains a wish list at this point of time rather than any tangible data point that we are witnessing.
Ravi, the other debate has always been as to, where is it that there's valuation comfort? Because the SMIDs have run up so much, the valuations are so frothy over there. Is it a given then that stick with large caps and the bottom-up stories, which we've already seen begin play out, I think, all through the month and especially yesterday?
No,
and
so
ease off from the SMIDs?
It has been an uneven recovery. I won't say it's been across the board. Capital goods oriented or capex cycle oriented companies are doing much better than consumption oriented, export oriented, services oriented companies. And I think even specialty chemicals for that matter, the companies have been reporting really bad numbers. I think that cycle is probably nearing an end in terms of being bad. So I would focus on those areas to look for value. Relative value already exists. The absolute value probably we would want to wait a couple of quarters more because the numbers are still not reversing. So I think, for example, there is one area, plastic pipes, where the reversal has already now begun. The PVC prices have now started going up. So that is one example of an area which was not doing well for a 3, 4, 5 year, 3-year period post-COVID, and now there has been a revival. So I think those are the kind of pockets that we would want to focus on.
So plastic pipes you said specialty chemicals and what else?
Consumption at the, discretionary consumption as well as staples.
Just wanted to take a moment and take a look at the market because it's a 3.5% fall right now in the markets. The Bank Nifty is down 1800 points and look at the leads. It's not as wide a gap as it was anticipated earlier. So NDA right now stands at 286 thereabouts and the Indie alliance of sorts is around 218. So that is I think what is making the market a bit nervous. Take a look at India VIX. That surged 25% on an intraday basis. It's trading at the levels of around 25. So clearly there's a bit of a nervousness coming back and the Nifty is now below the mark of 22,500 thereabouts. So massive surge in India VIX and a sizable drop in the Indian markets right now. Today you have the wish list ready, Ravi, in terms of what to buy and just are you missing out on the opportunity of perhaps putting in those orders?
More than that, are you shocked with the tally so far?
Yeah, absolutely. This does seem to be a much closer fight than was anticipated for sure.
Yeah, but early leads, let's see where it goes. But for now, yes, a bit of a dramatic turn. But do you think anything changes for the market or your thesis, let's say, if it is a narrow margin, will their political, kind of capital that they have to push a lot of these agendas get subdued a bit?
Let's see what the margin is eventually. But I wouldn't think so if we are assuming that the current dispensation comes in. But if it was there was to be a change in government, for sure there will be a big change in the sectors that will do well as compared to. I think that will push the market even more in favor of consumption oriented sector is what I feel.
Okay. Yeah, it's pretty interesting to just take a look at to what really these numbers are currently throwing up. But we'll have to wait and see what the final tally is. As of now, 289 and 215 for the opposition. I was just wondering and wanted to get in your take on the overall earnings momentum. Ravi, what exactly is it that you're penciling in? Any sectors that we could see positive, negative surprises?
No, so the momentum continues in the capital expansion areas. I think the order books have been fantastic. A lot of the companies we track are growing more than 25-30% in top line. Margin expansion has been more than anticipated. Renewables is one sector, defense, railway. So the areas where the earnings growth is strong, the markets have recognized the same as well, and that is kind of factored into the price as well. So I don't see a scope for a fantastic positive surprise over there. But the areas where I think the fundamental or the quarterly results have not been coming good, I think it will be interesting to see how the stock price react over there. A less fall over there will be a sign of bottom.
By the way, there's been a huge spike in the India VIX as well. Of course, the market has fallen from what the GIFT Nifty was indicating earlier this morning. But 2611 now on the India VIX, and that's a spike up of almost, or rather a move up of almost 25% that you're seeing. It's pretty much a reversal and a mirror image of where we left it off in trade yesterday, right? All sectors are in the red right now. It's led by infrastructure, power, metals, telecom, oil and gas. And I'm looking largely at the F&O picture in the market right now. The biggest movers from yesterday, they're the biggest laggards right now. Adani Enterprises, Adani Ports, right at the bottom of the heap. It's almost a 10% cut on both those names. Coal India down 8.5%. SBI, which was, so to speak, the leader in trade yesterday, that's down 7%. So a complete mirror image of even the fall and the gain that we were sitting on. You've got L&T, which is down about 5%, Axis Bank, ONGC, Reliance, which was one of the biggest point contributors to yesterday's Nifty move, that's down almost about 5%. HDFC Bank is down 4.25%, and I can go on with the list of losers. In fact, there's only one Marico. So, Ravi, you were so right. I mean, if the market is getting nervous about the leads so far, consumption, Marico is the one which is holding out.
Okay. Cash flow throwing businesses are the ones where market will gravitate towards. In both the ways, businesses are resilient, as well as the fact that they have not done well for 4-5 years means they are hiding places for funds as well. So from both perspective, I think that is an area where money will gravitate towards.
Well, when you speak about consumption, again, is it the bottom of the pyramid? Because as of now, it's only the top, the premium segment which has been doing better.
So the premium end which has been doing well has been recognized by the market, but where the margin of safety lies is at the bottom of the pyramid, because that is where markets have kind of completely ignored. There have been no lead indicators pointing to a recovery over there, but if market are a lead indicator, then that is where the recovery will happen. So in case there is a government change, consumption will do well. In case government does not change, I would still hope that this government will come and this time around put some money in the hands of people. So that should also revive the consumption. From both perspective, it's the rural consumption where the value is arising, and one should be looking at playing that from the next 3 to 5 years perspective.
All right, Ravi, lovely having you with us in our studios. Thank you so much for taking the time out and walking us through your views on